Hi folks, and welcome to the Meaningful Money Podcast. This is Season 15, Episode 4. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we are, once again, great to have you with me. Now, in the last couple of weeks, we've looked at financial planning and introduced the idea of a timeline. Last week, we looked at how to arrive at and then work back from some goals to get a sense of what you need to do now to move towards those goals. And today, we need to move a step further. We need to move from goals to actions. Okay, so that's where we're going today after the main body of the show, usual drill. Read a review out, talk about what we're going to be discussing next week, a little bit more news about the Academy, all the good stuff, so stay tuned for all that. Before any of it, though, remember this podcast continues to be brought to you with the help of my friends at 7 Investment Management, who've been helping me out here for ages now, helping me out with sponsorship and equipment and all the stuff that really makes this show happen. So I'm really grateful to them for continuing to do that. Please check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. And also don't forget the Meaningful Money branded self-investment platform, which is pretty cool. Everything you need to know about that is at meaningfulmoney.tv/podcastinvest. So go check it out. Right. Goals are one thing. Talked about those last week, but we need to meet those goals by taking action today. So I want to spend this week and next week looking at the actions you're going to need to take really from two different perspectives. More on that in just a second. So remember, notes, links from today's show, they're all at the show notes. So if you're out and about right now and you've got no way of writing it down, don't worry about it. This is the only link you need to remember, and it's dead easy. meaningfulmoney.tv/PP4. meaningfulmoney.tv/PP4. That's for Planning with Purpose, Episode 4. Without further ado, let's have a look at what you need to know first. Okay, there are two different perspectives I want to deal with, really. One of my all-time favorite books is Getting Things Done by David Allen. I use its principles every single day to manage workflow and to get stuff done. So its follow-up, by the way, Making It All Work, is the title of the follow-up book. Even better in my view. It's absolutely life-changing stuff. Use it every single day. In Getting Things Done, David Allen talks about taking different perspectives on your projects and your actions, and he uses like an aircraft analogy, talking in terms of elevation. So I'm going to borrow that for today's show and talk about two different perspectives to your goals and the actions that lead to their fulfillment. A 40,000-foot and a runway level view. So a high level and a low level on the ground day-to-day sort of level. Okay, so in other words, high level view and a more sort of granular view. So today I want to talk about that higher perspective. We're going to call it the 40,000-foot view. All right, so that's where we're going today. Now, the second thing we need to know is that a 40,000-foot view means you can clearly see further ahead than a ground level view. It's simple physics, actually I think it's probably geometry, that enables you to see further away the higher up you are. Okay, I hated maths and physics at school, ironic really. Now, as financial planning is such a long-term game for most of us, a 40,000-foot perspective allows us to see clearly the path that we need to follow and to see further along that path at what's coming in the future. That's important because while life has a nasty way of chucking in surprises and obstacles that they weren't there a minute ago, there are some things that we can see ahead of time. And this allows us to make some decisions in the here and now that might otherwise be impossible to make if we only had a low-level, short-term view. We can see further ahead from a higher perspective. So here's an example. Let's say you take a long-term view on things like salary increases, promotion prospects, and you kind of run the maths and you see that maybe down the line you might have a lifetime allowance issue in your pensions. So you can make an informed call on that as to whether maybe to divert savings into other vehicles now rather than continuing to pile money into pensions. If you only had the runway level view of things. You might continue maxing out your pension contributions and potentially storing yourselves up problems down the line. Now, I appreciate as examples go, that's not going to apply to many of us, the lifetime allowance being 1.055 million at this point, but it will be for some of you. But hopefully you get the point. A high-level perspective, being able to see further down the line, can be useful for in-the-moment decision-making. So 40,000-foot view means you can see further ahead. Third thing you need to know is that a 40,000-foot view brings perspective. Now, that sounds almost exactly like the previous point, but bear with me, right? Now, as I was writing this episode, we've had the week in Parliament where everything's really kicked off. Prime Minister lost his majority. Quite possibly by the end of the time I reach the end of recording this show, we'll know when the next general election will be. Probably not, actually, because I'm recording this on a Thursday and it's all gone a little bit quiet. I think it's still in the Lords. But you know what? It's all kicking off, all right? Funniest thing, actually, it actually made me laugh out loud. On the BBC app, I was looking at the front pages of the newspapers, and it's the day after Boris Johnson's brother Joe Johnson resigned from his ministerial post. Best headline ever. Jojo goes. Made me laugh anyway. So it's really a sort of volatile time right now, politically speaking. And of course, it can be difficult to put things like that in perspective when you're down at the runway level, because events like this can easily just become all you can think about. They can become all-consuming because you're right in the thick of them. You're at the same level. They're happening now. You're living in the now. You know, what will this mean for my pension? What will it mean for house prices? Should I stop investing for a bit and stockpile cash? All these questions become very important in the moment. Now, by contrast, a 40,000-foot view shows you that even big things in the moment are always temporary. Yes, there are always threats, always wobbles in stock markets and stuff like that, always political shenanigans going on somewhere in the world. These things come and go. They wax and they wane, and yet capitalism prevails. Now, remember, the declines, the wobbles in stock market, they are temporary, but the advance is permanent. And from a 40,000 foot perspective, we can see that. Somebody reminded me this week that there are some things going on that are truly unprecedented, and we can't possibly know what the impact of those things will be over the very long term. Things like the level of QE still in the system. It's never been done before, right? And so, personally, I have literally no idea how that will pan out. Neither really does anybody else. Some people have a better idea than me how it might pan out, but they don't know how it will pan out. Nobody knows for sure. You know, maybe one day the whole system will go down the Swanee and we'll end up back in a peasant agrarian sort of economy, feudal system of kings and queens and barons and dukes and all that sort of stuff, but I don't think so, right? I think the current system that we enjoy now and have enjoyed for quite a while now, I think it'll persist, certainly for my lifetime, but who knows? Anyway, where were we? Perspective, right? It can be easy to obsess about what's going on around you and how it might affect things right now, but a 40,000-foot perspective means you can see further ahead, you can look back and see how things have behaved in the past, and you can stay the course in light of that. Think of it another way. If you look at a chart of the FTSE 100's performance over the past year, recording this in September 2019, you'll see that it's been very up and down. It's ended up roughly where it was a year ago, give or take. Look at the performance over 20 years, though. The picture is different. Even taking account financial crisis of 2007-8-9, TMT crash of 2000 to 2003, even including those things, FTSE 100 has performed very well. So longer time scale, higher perspective leads us to sort of understand and see patterns rather than panicking in the moment. Okay? So a 40,000-foot view enables you to see what's coming further down the line, right? We're up higher so we can see further and maybe head off some things or see them coming and make decisions in the current as a result. And also we can remember that really where we are now is just one point on a very lengthy path. Okay? But what does that mean right now? In the here and now? How do we move from goals to actions from a 40,000-foot perspective? What do we need to do? Okay, the first thing we need to do is to remember to keep actions focused but fluid. focused but fluid. Now, what I mean by this is that the actions we need to take need not be diverted in the short term. We need to take them, set them, and stick to them. They need not to be knocked around by whatever's going on in the short term, certainly not by the things that we can't control. The actions we need to take may need adjusting in future in light of our longer term, higher level view. We're going to get to a session on robust reviews in session 7 of this season, so I'll expand on this then a little bit. But for now, if we work back from our goals to establish actions today, that means we know what we have to do. Okay? Now, there's some variables involved, like growth targets. We talked about that last time. We've assumed those in order to give us the parameters to work within. They're assumptions, they will be wrong, but we use those in order to say, well, to get from A to B, I need to put C aside, assuming X% growth rate in the meantime. Now, the long-term perspective, which is gained from 40,000 feet, means we can see the prize. We can, see the future. We know we're going to get there eventually. That should inspire us to stay laser-focused in the here and now. We can see that result, and we know what we need to do now, given our assumptions. Now, as we progress along the journey, we might need to reassess some things. Maybe we need to reassess the growth rates we're using. Maybe we end up not comfortable with the level of volatility, how we're invested at the minute. Actual returns gained might mean we need to change some things, right? Our actions today might need to change as we see things from a higher level going forward. We need that 40,000 foot perspective to check our overall trajectory. How are we doing on the course? Do we need to adjust course where necessary? We mustn't be wedded to our action points determined at the outset. We've come to them now in an intelligent way, with assumptions, looking ahead along the timeline, and we've worked it back to say, I need to do this now. But our high-level perspective means they may need to change, so we need to make sure that they can be changed, okay? We mustn't be wedded to our action points, which are determined at the outset. We need to be prepared instead to hold them lightly, adjust them potentially where necessary. Now, the second thing we need to do is to set those actions as if nothing will ever change. Potentially confusing that, but stay with me. While our 40,000 foot perspective will allow us to make changes as we go along, it allows us to do that because of our overview. It should also provide us with some reassurance that actually we should very rarely need to make changes. So we need to set our actions up at the start as if they'll never need to change. So let me just put it another way. We need to set up our actions so that they can change while accepting that probably rarely they will need to. So the best example I can think of for this is in determining your investment approach. We'll get to in a minute. Your goal might be to achieve FI by such and such a date. Okay, to do that, you need to amass, say, £500,000 between now and then. And to get there, we've worked out that you need to save so much a month now and increase that savings rate by so much each year. You also need to invest to aim for your desired level of return. All right, that's the other variable. So what are the variables? First is your level of savings. You can control that. You can adjust it as necessary. Why might you need to adjust it? Well, in light of the performance, perhaps. Probably the most likely reason. If your portfolio doesn't perform quite as we would like, you might need to increase your savings level to compensate. All right, now you could adjust your portfolio. You can say, well, the numbers are now not stacking up. I'm going to need to take more risk to get there. But there's a danger in that. It's certainly a far less robust approach to sort of cooking the books, if you like, tweaking the figures to get to your goal, because you can't control future performance. You can control your savings rate. Tweaking your investments to try and make the sums work, get a higher return so you hit your target, that offers no guarantee that things will work better post-tweak. They may work worse, right? We can't know. But we can adjust your savings rate, and we do know, to the penny even, what the impact of that will be given the assumed growth rate. It will have an impact. Moving from goals to actions then works like this. Remember, our goals are MT. They have a measurable sum of money attached to them and a T for timescale. From there, you can work out, using the tools we talked about last week, what you need to save in order to meet those goals with an assumed level of investment return and assumed inflation rate. Set your investment approach with a view to hitting that desired return and never change. Let me say that again. Set your investment approach with a view to hitting that desired return that you need and assume it'll never change. I'll get to some suggested growth rates in a minute. If then at review you find out that you're off track, then you can make an adjustment to your savings rate or to your timescale and make the numbers stack up again. All right? Variables, remember. Assumed growth rate. It's only an assumption. We can't control it. We can control how much we're saving, and we can control the timescale. We can move it back or forward. Okay? So that's what we're going to be doing at review. Do we need to adjust our savings rate? Do we need to rethink our timescale or whatever? Another example is maybe to make decisions about things like tax wrapper choices. You have to do that based on today's rules. That's all you can do, right? Don't be put off, for example, saving into a lifetime ISA just in case, well, one day the lifetime ISA might be withdrawn, so there's no point. Well, it might be, but something else will be offered at the time, and certainly you don't want to have missed out on the benefits of a lifetime ISA in the meantime. So don't not do something now because it might not be an issue or it might not be a possibility down the line. Another example is, well, I used the example earlier on, in fact, of maybe lifetime allowance things. Do you change what you're doing now in light of the lifetime allowance issue you may have in 20 years? Well, you can, but we need to be prepared to be nimble there because the lifetime allowance might be abolished next year, okay? So we need to be nimble. When we're determining actions based on our future goals, we can know that the landscape for things like wrapper choice and investment approach probably won't change much over time, right? Probably won't change much. It tends not to. Okay, so next thing we need to do is to set your investment approach. Finally, I hear you say, let's get practical. So we've got our MT goals, right? MT, not empty, measurable and time-bound. And in working out what we need to do to achieve those goals, we have assumed an investment return, okay? We now need to actually invest our money in such a way as to aim to get that return. The problem is nobody knows how shares, bonds, all that stuff will perform in future. So we are guessing, of course we are. Now, I've created some sample asset allocations which they come from my Learn How to Invest course, which is shortly to be rolled into Meaningful Academy. But they serve to show how different allocations have performed and show that historically, at least, a higher equity content leads over the long term to higher returns. Now, disclaimer here, folks. I should put a big red box on the screen or something. This is not advice, okay? I have no idea if these asset allocations are right for you. They are only examples. In fact, there is no right allocation. I said that in a 5-Minute Friday video a couple of weeks ago. So I've provided these allocations as a download. They're at the show notes, meaningfulmoney.tv/pp4. Don't use past returns to set your targets, right? I'm not even going to mention the returns of the various asset classes here, even though I've been looking at them. When I was writing this, I was looking at them thinking, do I mention them? But I'm not going to because they can be wildly misleading, okay? Instead, we're going to set some benchmarks. They are arbitrary. So over the past 10 years, the sample asset allocations, right, that are on that sheet, they've exceeded the benchmarks I'm about to give you, right? But the last 10 years have been weird, very weird. Coming from a very low base, remember, March 2009, just over 10 years ago, was the low point in markets for a very long time. It's been quite a ride since then, but a significant increase since then. So in the last 10 years, the portfolios, the asset allocations have outperformed the benchmarks. In the previous 10 years, they didn't, right? Because we had the tech bubble crash bursting, the credit crisis of 2007, 8, 9. So those 10 years were very challenging. So it's easy to say, well, over the 10-year average, these portfolios have done this. It's utterly irrelevant, right? So we're going for suggested assumed returns, not actual returns, because they're not guaranteed. So I've got 5 asset allocations. They're in the book, actually, if you have the Meaningful Money Handbook. Cautious, moderately cautious, balanced, moderately adventurous, and adventurous. So 5, ranging from cautious up to adventurous, okay? Now, to each of those, I attach a target return. Note, not an expected return, as follows. So for a cautious portfolio, target return of 4%. Now, that's gross. So if you're assuming 3% inflation, that's only 1% in excess. Moderately cautious, 5%. Balanced, 6%. Moderately adventurous, 7%. And adventurous, 8%. So 4, 5, 6, 7, and 8. From cautious to adventurous. Nice and neat and tidy, just how I like them. So what do? Take a look at how you're invested now. Which of the sample allocations does your current portfolio most reflect? From there, maybe you can say, right, okay, based on this, I'm going to take that 7% assumed return, or 6%, or whatever. So let's say you're invested currently in Vanguard's Life Strategy 80 fund, right? Life Strategy 80% equity. Well, that fairly closely reflects the adventurous sample allocation on my sheet there. So you might say, okay, given that I've assigned a target assumed return of 8% to that adventurous portfolio, that might be the figure that you use to work out your goals, right? And your actions taken today. So you can assume a target return in that case of 8%. I am assuming that if you're in this planning with purpose stage, you have established your risk profile, you understand the link between risk and returns, you're comfortable with volatility. We've gone over all that stuff in previous seasons and previous episodes. So look back, go to the Learning Center on the website. It's right at the top, link there. And there's a search bar there, and search things like volatility, risk, and you'll get the best content that I've put out on those subjects. This season, though, is for folks who have basically dealt with all that, and we're moving ahead of that. So I don't want to mollycoddle you. You know the risks. You know there's no guarantees. All I want to do is to give you some kind of guidelines for making assumptions on future growth. So take a look at my sample allocations, see how your current portfolio measures up to how things are invested, how much in shares, bonds, and all that sort of stuff. And then maybe use the nearest suggested growth rate. Okay? We got that? Hopefully. All right. Last thing I think we need to do today is to keep it simple with pots, notional pots, right? From a 40,000 foot perspective, I think the only other thing we can do really is to simplify our lives with some kind of pots approach to meeting our goals. Now, to an extent, this might affect your choice of tax wrappers, but we'll get to that next week. Most of us really have one major goal, which is to reach FI one day, retirement if you like. Think of this as a pot we're going to need in addition to any secured income sources that we've got, such as DB pensions, the state pension, rental income from property, all that sort of stuff. So we have our secured income level probably coming in at different points, and we will probably have a gap between that and our desired expenditure level. And so we need to fund that gap with capital, and we're going to need to save up that capital. When we've got enough of that capital to fund the gap between our secured income and our expenditure, we've cracked it, right? So that's most of us. We have that FI goal, but then we might have some smaller goals along our timeline. Things like providing for school fees, help with university, big holidays, buying a camper van, all that sort of stuff. And I suggest that for these smaller goals, you think of these as pots of money as well. Most of us won't have many of them, right? Whether or not your goals are provided for by actual physical pots of money depends on your view. I really like that approach. I like having different accounts for different goals, right? Talk about that next week as well. For now, though, I want you to identify how many pots you might need, in addition to your big pot for FI. Then identify an investment approach and a target return for each of those pots. Chances are, as we've said, your FI pot will probably have multiple moving parts, but your smaller goals probably will just be much more straightforward, right? Again, more next week. So to summarize, from a 40,000 foot perspective, that's about all we can physically do to set our actions, to move from goals to actions, is to choose the investment approach for each notional pot based on assumed return and timescale for each one. That's really the high level approach to building wealth. I want to get there in this period of time. I need to work back from that to work out how much I need to put away to get there. All right, so all assumptions, and we'll tweak it as we go. That's what the session on reviews will help us with. Most of our decision making happens on the ground, day to day, at the runway level. Right, that's where things happen. Like, whose name should this account be in? Which tax wrapper should I use? Do I keep adding to my pension, or do I bring in a VCT or something interesting like that? Setting the investment approach is pretty high level. Which pot you hold that money in is actually pretty much a ground level thing, right? Sorry, the road is very noisy behind me today. I'm not sure whether you can hear it or not, but it's very noisy. I can hear it really badly. I got to say, folks, this episode has been really hard to write. I battled with it for many evenings. Okay, I'm still not sure I fully got across what I wanted to, having now just recorded it. But hopefully the season as a whole will do its job in addressing the things that those in this planning with purpose stage need to know and do. I think part of the challenge is that I'm convinced that simple is best, and it's difficult to simplify a fairly complex combination of ideas and actions in such a way that can be communicated, particularly in audio-only form. So anyway, I hope it's helpful. Fire any questions at me. I'll do my best to answer them. Do that at the show notes, meaningfulmoney.tv/pp4. Now, here's a review from Ewan Find, right? This is left back in February. Shows you how far behind I am on the reviews. I discovered Pete's podcast a few months ago, and I'm so glad. I learned lots about managing money and financial planning. The current season is fab. He's talking about season 13, Millennial Finance. And I'd highly recommend it. I know it's having a big impact on how I think about and manage money. Keep up the great work, Pete. You and Find, I'm really glad that Millennial Finance season went down really, really well, and I'm proud of it. But kudos to you for taking that information and put it to work. That's what it's all about. So thank you for sharing it with your friends and family, I hope. And then, and thanks for leaving a review. Really appreciate it. If you want to do the same, meaningfulmoney.tv/iTunes. If you're on Apple, it's easily the biggest podcast repository, so that's why I put it on there. But if you can leave a review anywhere, then please do. It really helps me out. Okay, as I speak, the launch phase, the founders launch phase is open. All right, this episode will go out on the 25th of September. We opened it 2 days ago on the 23rd of September. So if you want in, assuming it hasn't sold out by now, probably not in 2 days, but if you want in, you need to go to meaningfulacademy.com, where we're opening the founders launch for phase 2, the build wealth phase of the academy. So dive in there, see what we've got to offer, and if you like the look of it, then come and join us in the founders phase of the build wealth phase of Meaningful Academy. It's very complicated, isn't it? Those 100 people, I want to help me build it and really to help me refine the content to be the best it can be. And in return, you get a deep discount on the cost of the academy, on that phase of the academy. So definitely check that out. Okay, meaningfulacademy.com. Okay, next time we're going to be coming to the runway level, right? The ground level perspective on our goals and actions. So hope you are looking forward to that. I certainly think I am. I think it'll be easier than this one, a little bit more nitty gritty. All right, but that's it for this week. Questions and comments at meaningfulmoney.tv/pp4. Thank you so much for joining me. I'm enjoying this season. Hope you are too. I'll talk to you next week.